Super excited today to have some great panelists for this session, where we'll be discussing the slow rolling, I guess, in some ways, but in other ways, very, very quickly manifesting banking crisis that's now stretched across the globe and affecting all types of markets and all types of businesses, not just markets. So I'll start with Ivelina Green. Eva is founder and portfolio manager of Pearlstone Alternative, which is a long-short special sits shop in London. Before that, she was at CQS running the special sits business. And before that, she headed up distressed trading for Goldman in London. We also have Ben Hunsaker here, who is the head of structured products at Beachpoint. Ben has some interesting experience, given that he worked at Countrywide on their desk there during the last significant banking crisis that we had here in the US, at least. So I'm sure he'll have some insight into the workings of the structured product markets today. And we also have Terry Maltese. Terry runs Maltese Asset Management, which is a specialist focusing on the banking sector. We've been invested with Terry for, I want to say 20 years now, close to it at least. I've known Terry personally for maybe 12 or 13 years. And when the banking crisis started to unfold 2 weeks ago, the first person we called was Terry. And we basically said, what's going on? What's the situation? What's happening? What's going to happen? And what should we do about it? And he's given us some invaluable insight and advice regarding what's going on and how we should handle ourselves, both with respect to our clients' investing, their personal cash and underlying portfolio company cash as well. So it was super insightful to have him. And so I thought it'd be very good to have him here to kick off the conversation, to tell us about basically what he sees has gone on, his take on it, current kind of update on the situation, because it's unfolding very quickly, and his potential scenarios for what he thinks could take place over the next coming months. So I'll turn it over to Terry.
Okay, thank you, Terry. So I'll start with trying to give a little bit of an explanation of what triggered all of this. I have to start with a comment, which is most of what you've heard so far is not accurate.
That's comforting.
Yeah, unfortunately, but true. So Silicon Valley management clearly made some mistakes managing their balance sheet. But the fundamental challenges that they faced absolutely did not trigger the bank's failure. It was a pretty basic strategic error related to an announcement around a capital raise that really caused Silicon Valley, or SVB as we call it, to fail. So just quickly, the capital raise that they had announced was expected to close on Thursday evening, March 9th. The blunder that created the beginning of the end for them was they made the announcement of this transaction on Wednesday night, meaning that they were going to allow the stock to trade all day on Thursday with this overhang of the offering. And basically, that triggered a steep decline in the stock, which then triggered some investor panic, which caused the stock to collapse, which in turn caused some loss of confidence, started driving depositors out, and then very quickly it was over. And I'll walk you through some of the detail in a moment. But so SVB experienced huge deposit growth in and around the pandemic. Most of those deposits came in big, large chunks, and most of them came in from VC-backed technology and life science companies. SVB then went out and bought a mix of securities with these deposits that came in. Unfortunately, some of the securities were long duration securities. They classified some as what we call held to maturity and some as available for sale. I'm going to skip the bank accounting lesson for now, and then during the Q&A, if people really want an explanation of why that was relevant, we can come back to it. So leading up to the debacle, as these tech and life science companies were burning through cash, they withdrew about $10 billion of deposits from SVB, and more was expected. This was not a surprise. If they were to sell securities that they had classified as held to maturity, it would have likely taken their capital down to around zero. Okay, so there was a lot of news and a lot of reporting around this issue. Okay, this was not new news. This was true since last summer, and analysts and investors knew this to be the case. So this, as they call it, this insolvency or this bond portfolio, although it was a problem, it was, everybody knew about it for 9 months. It wasn't the issue. So what they did was they clearly identified the deposit outflow was an issue and it needed to be addressed, but it wasn't life-threatening. So on Wednesday afternoon, March 8th, after the close, they announced they were going to sell available for sale securities. They were going to sell $21 billion. They were, which they had already done. They booked a $1.8 billion loss. By the way, these securities that they sold had an average duration of 3.5 years and an average yield of 1.8%. They announced a plan to buy $21 billion of securities with a 5% yield and a 1-year duration. They were going to add $15 billion of borrowings to create more liquidity on the balance sheet. And then finally, they announced a $2.25 billion capital raise. So I want to be clear, at this point, none of this threatens the viability of Silly Valley. The next part is where things began to unravel. So what normally happens in a deal like this is they line up enough investors privately, bringing them over the wall to complete most of the capital raise. And then what would normally happen is they announce the capital raise on, say, Thursday night publicly. They allow other investors to come in. They close and price the deal Friday, in this example, Friday morning. That's what's common. And they didn't do that here. What they did here was they announced it on Wednesday night, but still saying they were going to price it Thursday night. So as I mentioned earlier, that meant the stock was going to trade all day on Thursday with this overhang of this offering. So the next couple of parts, we really watched and witnessed it play out real time as we got calls, emails, tweets forwarded to us. So what basically happened is on Thursday morning, March 9th, the stock opened and immediately traded down sharply. So the stock went from around $268 to a price around high hundreds, 200. And this was basically investors saying, there's no reason for me to hold the stock here when I know this big offering is coming and I can buy it at a discount. Unfortunately, that initial drop that took the stock from 268, which is where it closed on Wednesday, to around 200, as often happens, it caused some panic. We started then hearing questions like, is there something else wrong? Is there another problem? This brought more selling, and then the stock tanked further. That steeper decline shocked some customers who then started to wonder, are my deposits safe? And we started seeing those emails and hearing about those tweets. And relatively quickly, investors started to hear about depositors panicking. Well, that's a run. And then what happened was hearing about the run caused investors to panic more and created more selling and a steeper decline in the stock price, which in turn spooked more depositors. By 4 o'clock, the stock was $106. It was still falling. And now you had some VC firms and others advise companies to withdraw deposits from there. About 90 to 97% of their deposits were uninsured. And remember, because these came from tech and life science companies that had raised large amounts of equity, these deposits were flying out in very big chunks. This vicious cycle of selling the stock by panicked investors, withdrawing deposits by panicked customers, just continued to feed on each other until in the end, you got what was a classic run on the bank. Although how we got there was really quite unique. In our opinion, and most of the experts in our space that we've talked to, all believe if they waited till they had enough investors lined up to do this deal the proper way, and they didn't have that overhang, the stock would not have tanked, the panic would not have set in, and you wouldn't have had the run on deposits. So that's essentially what happened at Silicon Valley. Now, looking forward, and I would say, while a lot of banks face some of these safe challenges, there were definitely some things that were very unique to SVB. One, the very high exposure to tech and life science companies. Two, the average size and amount of the deposits that came in. Certainly the large interest rate and duration bet that they made on the balance sheet spooked people a little bit more. But then finally, in our opinion, the biggest blunder was sending the stock into a tailspin by letting the offering hang out there for a full day. In most bank failures, the fuel of the failure is credit problems. The spark that actually causes the regulators to seize a bank is either that those credit problems wind up either wiping out the bank's capital or create a run on the bank's deposits. What was very unique here was we had the spark and the explosion, but we didn't have any of the fuel. There were no credit issues, but the spark was so big, it created the explosion by itself. Bank runs are basically self-fulfilling. What causes a run is a fear of a run. Now, it's also worth noting here the speed at which all this happened. So back in 2009, when Washington Mutual failed, 9% of its deposits left in 2 weeks, and that was considered a run. At SVB, we think 25 to 28% of the deposits left in 1 to 2 days. So it was a much more violent run. What then happened is people started looking for other companies that could possibly face similar challenges and trigger a similar run, which again becomes self-fulfilling. A short list developed. Signature Bank, and by the way, so SVB got seized on that Friday, and then Signature Bank, which was on that short list, was seized on that Sunday. Looking forward and looking at what happened, in our humble opinion, there was one thing that the regulators and politicians could have done to calm fears and greatly reduce the risk of more runs. And that was a very simple solution. It was to raise or completely eliminate the FDIC insurance cap on deposits for some short period of time. Because as I said earlier, a run can cause a run, but the reverse is also true. Removing the fear of a run is the best way to avoid the actual run. Sadly, there was too much political resistance to this. Treasury, the Fed, and the FDIC made some joint announcements to try to calm fears. The actions they took helped, but they did not help as much as doing the simple task of guaranteeing the deposits, which they chose not to do. Looking forward, we do not expect a lot of additional failures. We wouldn't be surprised to see a few more based on what we're seeing. At the same time, we would not be shocked if there are no more, and we've seen last of it. Most banks' deposits have been fairly stable, and even the ones that have had a big decrease in deposits in the last week or 7 days or so have seen those deposit outflows slow dramatically. Bank stocks are now down 20 to 25% this month, and 20% year to date. They were down 20% last year. At some point, the fears will subside. There'll be some discernment between companies that are well positioned and those that aren't. And in the near term, psychology will be very important. Given the absence of really severe credit issues, we think some terrific opportunities are going to develop, and that's going to come with capital raises, deeply discounted stocks. We're already seeing some weird things in the debt of some of these companies. So we think that as the dust clears, it'll create a lot of opportunities.
Terry, do you, on the credit issue, as the Fed has embarked on a kind of unprecedented rate rise cycle in terms of the speed and degree, things are breaking, right? Silicon Valley Bank is an example of something breaking that was kind of unintended. And, eventually, I think these rate rises will have their intended effect on the economy. Right now, it doesn't seem like there are significant credit issues. I agree with that. What are your kind of assumptions for credit issues going forward for the remainder of the year 24? Do you think they deteriorate? Do you think that it becomes a problem for the banks?
So credit's definitely going to get worse. This was an opinion we had before any of this happened. Credit has been so good that it just can't get any better. And as the economy slows, there'll be some issues. What I think is important, so credit will get worse. We think we're in the very early stages of that. So yes, later this year into next year, you'll see some credit losses. But it's important to keep in mind, and we had done an analysis of this, people think incorrectly that banks blow up every time there's a recession. If you look at all the recessions over the last 70 years, banks lost money in one recession, in 1 year of one of those 7 recessions or 9 recessions. And that was during the global financial crisis. So yeah, no question, credit costs are going up. Is it going to cause banks to actually lose money? No, we don't think it's going to get anywhere near that.
I think maybe it's a good time to turn to kind of the second order effects of banks, failing and coming under pressure. And that's we're going to turn over to Ben, where he can chat about the markets that he looks at, which are the structured credit markets, a lot of mortgage credit, commercial mortgage, residential, and corporate structured credit. After we called Terry and had our conversations with him regarding what's going on in the banks, Ben called us and said, the opportunities are looking very, very interesting right now. And people are selling assets at pretty accelerated paces and indiscriminately taking price basically as a seller. So Ben, so I'd like to turn it over to you and hear about what you're seeing and what you think was the actual transmission mechanism from the Fed or from the banks failing to your markets. I think that would be helpful to hear first.
You got it. I can't believe we're 2 weeks into this and I'm 6 months into it. And that's the first time I've heard Silicon Valley Bank called Silly B or Silly Valley. Like, Terry, you just made my day. That's going to be a new term around here. I do think what Terry said has an interesting point that I want to call a distinction from for both First Republic, maybe a little bit for PacWest and some of the other banks, including Signature Bank, where you have some potentially problematic assets in the form of short-term real estate loans and heavy, bad asset real estate concentration exposures. Silicon Valley Bank didn't have those, clearly a different situation. But if you look at First Republic Bank, for an example, a lot of the people on this call might have very, very below market interest rate lines of credit or mortgages from First Republic Bank, where you were looking at where you could borrow from them and taking out 200 basis points of negative NIM and saying, how does this business model work? Well, it does when there's a high PV of that customer acquisition. It means the NIM's problematic going forward. And if you ever lose that asset base, the value proposition is different. And when you get to the First Republic banks of the world, a lot of the loans on their books are not BFTP eligible or BTFP eligible. Some of the agency mortgage-backed securities and treasuries are, that's a good way to plug a gap in the temporary facility that the FDIC and the Fed have backstopped. But for First Republic or for, Signature Bank, those assets would not have been eligible to be pledged. And so you're left wondering about the credit, putting aside the duration and the negative convexity. Negative convexity being the key point from a mortgage guy's perspective. The irony in all this is the weapons of mass destruction, the forward starting swaps, the derivatives, the things that banks use to manage their interest rate gap, their duration gap, would have been what could have bailed out some of the potentially avoidable mark-to-market held-to-maturity losses. Those were absent, and the convexity hedging was absent. So those 3.5-year duration assets that Silicon Valley Bank might have been selling to the mortgage market, those might have been 7-year assets because of the way interest rates had moved and prepayment expectations had shifted from a short asset to a long asset. And that's where you start to look through to some of the underlying high quality liquid asset HQLA portfolios that a bank would sell to find liquidity if they were going to move something from HTM to available for sale. And it first starts in the agency mortgage markets, one of the biggest, most liquid sectors of the US bond universe, where spreads gapped out, the difference between the 10-year treasury yield and where agency mortgage-backed securities were trading, it blew out. But at the same time, the effective option-adjusted spread you were earning on agency mortgage-backed securities didn't really move that much because interest rate volatility just went off the charts. You had interest rate volatility that was, really only higher for a brief period in 2008. Interest rate volatility topped where we hit in the COVID era crisis. And so the ability to manage some of the gamma and some of the negative convexity in that universe went down, and it really just caused prices of HQLA assets to drop. And so that has these really negative knock-on implications for the less liquid assets in the structured credit universe. And one of them in particular that I think you're hitting on, Terry, is commercial mortgage-backed securities, commercial real estate-backed debt, which has a very distinct transmission mechanism through the regional banks, much less so than through the GSIBs or some of the money center banks, where they're lending to assets that wouldn't fit the trophy asset balance sheet insurance company lending profile. And you're coming from a place where that was already a problem in the broader credit markets and a risk that was on most people's radar, because you look at how real estate, demographics may have changed post-COVID, and the potential operating income that a lot of different types of real estate could generate, particularly office. And you look at where cap rates, which is how you're valuing real estate, the operating income of a given asset divided by its cap rate, basically the risk-free rate ascribed to that property plus a spread. And you had to mark to market the entire real estate universe and say, wow, there's a lot of real estate loans that have been made from the 2020, 2021 lows in interest rates that were on potentially optimistic operating assumptions that are effectively levered to higher interest rates. And you're suffering the same effective devaluation that the Silicon Valley banks have suffered from an asset liability matching perspective. And those credits will eventually have to get rolled over. So all of this happening in the regional bank world at the same time that big insurance companies in the United States are being forced to sell certain high quality commercial mortgage-backed security assets for their regulatory capital needs, in part because of this, quirky little NAIC ratings methodology that dictates how some capital has to move in that universe, and in part because there all of a sudden was huge headline risk to owning commercial mortgage-backed securities, even if they were AA or single A or AAA rated. If you're investing a portfolio that's supposed to be in low risk assets and you're seeing PIMCO and Blackstone walking away from office portfolios, there's a good reason that you don't want to own those assets through what could be a lot of carnage. And the regional banks add fuel to that fire if they're not going to be lending. And not only are they not going to be lending, but places like Silicon Valley Bank are extending a lot of capital call facilities and NAV leverage facilities to the end providers of that credit, creating private mortgage lending across the commercial universe. And so a lot of things came together at a certain point in time where you had probably one of the worst weeks for the nominal on-the-run spread of BBB commercial mortgage-backed securities since 2008. You had the on-the-run bonds go from probably 65 to 40 really quick. And that was before we even got into this week and had to talk about Credit Suisse.
And were there actually things transacting at those levels? Because in other times of stress, you see marks down there, but there's really not a liquidity. You can't really trade. No one actually wants to give them up at those prices. Were you actually able to transact?
Yeah, and that's been the unique difference for commercial mortgage-backed securities in this crisis is there were enough bad headlines that people were willing to take pain, sell bonds well below where their pricing services valued them the prior day because it was get out or move on. Whereas in the COVID times, not a lot transacted at the COVID lows. Things are transacting now and they're transacting lower and lower by the day.
How would you rate this in terms of buying opportunity for your markets throughout your career? Is this near the top quartile?
Gosh, as a relative value credit guy, it's always like somewhere in the top third or the top quartile, unfortunately, which means I'm wrong most of the time. But I think there's pockets of opportunity here that are the baby thrown out with the bathwater in commercial real estate securities. I still think there's a lot more pain to come, but some of the easiest credit underwriting is what's getting sold first. Generally, right. In a crisis, you have the most liquid things sold first. And so when a AAA bond or a AA bond prints down 25 points in a week and it doesn't have a lot of credit risk or convexity, that has to be up there in your conviction list.
Right. It's interesting. It's the negative feedback loop that exists across all of your markets is interesting, right? There's leverage in the system. A bank is gotten caught wrong-footed. They need to sell assets, take down their exposure, which causes a panic in which their stock trades off. Volatility in rates spikes. People's value at risk measures explode. Volatility for portfolios, whether they're equity long short portfolios that happen to have financials in there, and banks need to de-risk. People who are doing fixed income arbitrage need to de-risk. It feeds back into more panic. More panic puts more pressure on the shares of banks and potentially causes more runs. It's this negative feedback loop that I think is incredibly fascinating to look at. But I'm going to turn it over to Ivelina. Obviously, we haven't spoken about Credit Suisse, which has been incredibly problematic for as long as I can remember. And they put in place a restructuring program that investors were, I guess, okay with, but given the current market conditions, it wasn't good enough and wasn't going to happen fast enough. So I'd like to hear kind of your take on the European banking market, and particularly Credit Suisse, and its effect on the markets that you trade, which is predominantly, corporate credit in different special situations. You're on mute, Ivelina.
No, absolutely. What I wanted to say was, again, in terms of second-order effects, when it comes to Europe, the second-order effects were actually first-order effects insofar as, the spark that started in the States obviously moved very quickly to Credit Suisse, considering the fact that, obviously that's something that has been top of minds for people for, quite some time, really since 2021, and obviously the significant write-down they needed to take on the back of, hedge fund failing. So I think ever since Europe has been slightly uncomfortable, and I think global markets have been slightly uncomfortable with Credit Suisse. But obviously what happened to the States ultimately led to things really becoming untenable. And again, as Terry mentioned, these things feed on themselves, things that, people were comfortable with the previous day, all of a sudden people feel they don't have enough disclosure. People feel that they don't have enough definition. People feel that they don't have enough timing. People don't feel that they know what the bank is worth sum of the parts. And then it becomes a self-fulfilling prophecy. I guess the big difference in terms of Credit Suisse versus Silicon Valley Bank is the fact that obviously Credit Suisse is Swiss. And the thing about Switzerland is that I don't know if a lot of people know that, but its GDP is smaller than the GDP of Florida. So in terms of backstopping an institution of that size, that wasn't going to be as straightforward as it would have been for the US to really step in and help on the deposit side of things. So really help with reassurances across the board. So it really made sense that being bailed out was not going to be straightforward, which is why I think even in terms of the deal between CS and UBS, until the very last minute, I think that was very much less than certain. And I think that, again, it went to the wire in terms of, again, getting announced. And ultimately, the way it got announced, I think at the beginning spooked people more so than the announcement itself. What do I mean by that? Obviously, there was a resolution that ultimately saw Credit Suisse writing down its AT1 debt, its subordinated debt, and at the same time, they paid a consideration to equity holders, obviously breaking the obvious waterfall that most investors would have come to expect. Now, that obviously sparked fears across the globe, but specifically Europe, actually, in terms of AT1 financing and what that means for AT1 going forward. So on Monday, we actually walked into AT1 in Europe being down 15 to 20 points. Now, that contagion, if it had stayed at those levels, would have been meaningful, because obviously, very straightforward, follow the math. AT1, 20 points lower, that means that banks are financing 50 to 100 bips more expensively. As a function of that, passed on to whether it is corporate credit, whether it is real estate, etc., would have been meaningful. Now, with that said, looking back over the past 48 hours, it seemed to be a little bit of a storm in a teacup, because we have pretty much recovered. AT1, shockingly to my mind, is pretty much back to flat end of Tuesday, as opposed to, again, down 20 points on Monday. So net short-term impact averted. The market unwound it. Now, the medium and long-term impacts, in my opinion, are going to be significantly more pronounced. Number one, I do think, again, in a buoyant market, again, oftentimes, greed overcomes everything else. And, AT1s look yieldy and people are piling into them. When the market is down, it's at that point that people start questioning, whether European banks and whether the European system at large is going to be respecting waterfall, and whether BRRD, i.e. the European Bank Resolution Mechanism, is actually going to work. Now, obviously, we had officials both from the EU and from the UK actually come out and, assert that the waterfall works, and, they are 100% supportive of the unified mechanism they introduced in 2016. Listen, I think that the market is doubtful. Quite frankly, I'm doubtful, because I have seen more exceptions to the rules over the past 10 years when it comes to European financial institutions, as opposed to examples of us following the law to the T. I mean, there are a couple of names that come to mind. You've got SNS, you've got BESH, you've got Monte dei Paschi, i.e., like, as usual in terms of European financials, it seems that, we figure out the resolution and then we try to make it fit within the existing framework. Here, I don't think there was even an attempt, most probably because there was no time to make it look like it fits. But I do think that it goes to the heart of, hey, how are those resolutions actually going to work? How are the restructurings of European financial institutions ultimately going to work? And are you being compensated for that type of risk in terms of, again, AT1? Now, there is obviously a lot of conversation, obviously, on the back of the actions in CS. Litigation claims have started trading in terms of these CS AT1s, and, groups are organizing. So I think that it will be interesting in terms of where that lands. Again, different views on how strong the case is, considering the fact that obviously it is not per se within BRRD. But again, listen, I think that that's going to be something that's very interesting to watch, because once again, European restructuring tools have been questioned for quite some time. again, I think that we have come really quite a long way when it comes specifically to corporates in Europe. Again, I think that as it comes to financials and systemically important companies and banks, where you can see sovereign involvement, the proof is in the pudding. Again, listen, let's be clear. I think that the definition of insanity is, doing the same thing over and over again and expecting different results. And when I look at, subordinated distressed financial risk in Europe being, completely carried out, that's the first quote that comes to mind, i.e. why did anybody expect it to be different? But listen, I think that medium term, that's definitely going to be back of people's minds. So it might be fine now, but the moment you actually see equity markets turn, whether it is because, again, rates are getting higher, because we cannot get core inflation under control, etc., I think that that AT1 risk will be shunned, and that can actually act as a multiplier in terms of tightening. But I don't think we're seeing it right now, which is why I think that we're finding ourselves in a very interesting spot. I actually do not think that right this second, what we're seeing, the tightening that we're talking about, has profound impact on core inflation, which is why I think that we're going to have to go higher in terms of rates, and that's going to have, again, multiplier effects once, ultimately it happens. So listen, I think that the chances of either hard landing or, inflation sticking around higher for a prolonged period of time has actually increased substantially. And the last thing I wanted to mention, just on the CMBS point, we are definitely seeing what Ben has been talking about in Europe, i.e. sponsors are starting to walk away from certain CMBS structures. And I think that that's something that will be interesting to watch. Again, different structure in Europe, considering the fact that a lot of our mortgages are floating also on the residential side of things. And obviously you got resets, which are a lot more regular. And I think that that's going to be something that's very important to watch because, listen, long term, here is my issue, right? I think that we all know that there are a number of asset classes out there that are, how do I put this gently, marked less aggressively than they should be. Here is the problem. The problem is that that's the fuel. What is going to spark fire? Quite frankly, if you don't have to realize the marks, right? There is nothing to see. So I think that what's happening, again, the moment you get mismatch between assets and liabilities, and you gotta match, actually you gotta take your assets to trading levels, that's when you have a crisis. Very difficult to predict because once again, in terms of a lot of corporates, in terms of a lot of financials, structured, it's not that straightforward to see, exactly what is the mismatch between assets and liabilities. But what we do factually know is that, a lot of people, most probably, whether it's hold to maturity bucket, whether it is marked to an external provider bucket, levels are higher than where they should be, in my view, given where we are in the credit cycle. So there's a lot of fuel. And, a spark somewhere, I think definitely has got legs. And that's what we saw over the past 2 weeks, in my view.
So we spoke late last year, Eva, and what you said stuck. I remembered it. You said the European credit markets are like an old creaky house that's about to collapse. You can hear the creaking in the walls, but it's still standing there, and you're not sure when it's going to happen, but you're pretty sure. I thought earlier this week or last week it was going to collapse, and I was going to call you and say, okay, is now the time? But I guess it may not be the time just yet. Just overall, Eva,
but it's still scary.
Yeah, it's still scary because you probably want to run out of that house, right? Just in terms of broader credit availability, the private banking markets and financing markets are much more important in Europe than they are in the US. The banks are a key source of funding for corporates, for real estate transactions, more so than they are here in the US. Have you seen any behavioral changes from the banks in their willingness to finance companies? Obviously, there have been changes since the tightening cycle started, but more acutely over the past couple of weeks. Any indications of where the banks are going to go from here?
No. meaning that like banks' behavior in Europe hasn't changed, and in my opinion, is going to take a lot more than that to change. Again, the way Europe, and it's very country specific. But for example, take Germany, right? A lot of banks literally just have the mandate to finance specifically, again, like those real estate developers or those companies, etc. So that is a really strong plank. And I got to tell you, most probably significantly stronger than what you're seeing in the US. It's going to take a lot more than that for those banks to really cut off credit. Now, that doesn't mean that there aren't issues, because once again, especially in real estate in Europe, away from the concerns that we discussed, i.e. like the fact we got floating mortgages and affordability and rates and financing and all that stuff, there is an element of we started really low, i.e. like cap rates in terms of prime real estate in Europe was 2.7, 2.8%. Yep. I mean, you move that out to 5%, that's 25, 30% impairment. And again, even in residential stuff. So net, I'm not saying, hey, the banks are going to pull out. I'm just saying it's going to get more expensive. It's got to get more expensive because they're not going to pay to finance you, right? They might not make money, but they're not going to pay you. So I think that, again, it's just a matter of, again, like maturities and, just refining, etc. Because once again, like banks are doing exactly what they've always been doing, amend and extend, pretend, etc. But again, like, it's funny, I was looking actually in amend and extend today, and I was saying, well, that's an expensive amend and extend, because like you got a loan deal, which was already, LIBOR plus, 500. So it's already close to 8. And now for the extension, they put in another 2%. So now it's a 10%, coupon, cash coupon. Like, these extensions are expensive. So I don't think it's going to seize up. And by the way, European banks, when it's all said and done, much better place where they were, quite frankly, in 2007, 2008, without question. But again, that doesn't mean that there isn't, some pain to be had, just as a function of rates and the fact that it's going to get more expensive. And quite frankly, again, it just goes back to the same thing that, quite frankly, the one thing that I've been talking about, all along. There is too much leverage in terms of, quite frankly, European corporates in the system, because we never actually delevered past 2008. So some of these companies don't really need, rates to go down. They need rates to go down to 0, or they literally cannot afford to pay the bill. And that's the problem.
Right. Terry, I want to go back to you for a second, talking about, it seems like I think everyone's in agreement here that the acute part of the crisis may be just over. And I think people have to come to grips with the reality that, they may have asset liability mismatches or duration mismatches in their portfolios. Do you expect any significant changes in the way the regional banks in the U.S. manage the asset side of their portfolios going forward? Do they need to do anything acutely at this point?
Look, there's 4,000 banks or 6,000 banks, depending on how you count in the U.S. There's 800, 900 of them are public. When the market looked for who else besides Silicon Valley and SBNY could possibly have this issue, it found 2, 3, maybe 4 others. So most of the banks have done a reasonable job managing their balance sheets. There are a handful that did not. But again, I want to stress, there was nothing new on Silicon Valley's balance sheet in March of this year that wasn't apparent in July of last year. But yes, so they're going to have to be more careful. I think that most banks managed, their duration risk well. I think the one thing that probably, so some will have to change, but I don't think it's across the industry. The other thing that I think banks will start doing differently is looking at concentrations of deposits. most banks, 30, 40, 50%, 60% of their deposits are uninsured. At SVB, it was, 90 to 97%. So I think concentrations of deposits and depositor flight risk will be looked at more closely going forward.
Got it. By the way, I forgot to mention earlier in the call that you can, all the people watching here can submit questions in the question and answer part of their Zoom app, and we'll select some at the end of the session in a few minutes here to see if we can get some answers. Ben, go back to you for a second. In the structured credit markets, obviously, banks have a ton of exposure to mortgages, and specifically agency mortgages, and it has a very direct impact on those markets. Is there anything, are the agencies behaving in any different way since the unfolding of this crisis, and has that created any opportunities for you?
Not on the agency side of the world yet. You've seen, the mortgage origination universe has been a little bit hampered for the last 18 months anyways. That was maybe the front edge of the crisis, and the way rates move today, maybe we're coming out of their acute little existential drama. But where you did see it matter for the banks is people who had non-agency guaranteed mortgages. So today, PacWest and their deal with Atlas's structured product group,
ironically, the ex-structured product group of Credit Suisse.
Yeah, those poor guys. Don't get me started, those poor guys. From what I understand, that ends up as a structured loan secured by some bridge loans that Civic, who PacWest had bought, had originated a relatively large portfolio of, questionably risky bridge residential and multifamily. That's where the opportunity set lies. The agency stuff, maybe negative convexity because they're priced so low to such long extension becomes a positive convexity tailwind for some of the unrealized losses on banks' balance sheets. It's the residential credit or the commercial credit that was well underwritten that starts to become a really interesting opportunity set, and maybe where people can have that private credit solution fill some of the holes that they've been talking about filling for the last 5 years.
Got it. Yeah, I just thought maybe the volatility in the market could give pause to maybe further issuance of credit risk transfer paper.
That's a great point. So for the last week and a half, 2 weeks, you've had the non-QM RMBS issuance markets basically frozen. And even despite that, where a non-QM securitizer can issue debt is cheaper today than where it was 3 weeks ago, because the front end of the curve has just shifted down so dramatically, and a lot of those AAA, AA, single A bonds price as if they're 3 years. So if your reference cost of capital is down, 60 basis points now, spreads could absolutely blow out in terms of how much wider AAAs get. And it's still an economic business line to be running, which is one of the things that grants credence to the potential NIM and the non-agency side of some of these banks' lending businesses.
Got it. Thanks. Eva, in Europe, are your competitors, your other asset managers, do you have a sense of, from a technical perspective, what their stances are? Or is everyone kind of just waiting to see? Are people putting money to work? You're a trader, and I always kind of like to talk to you about the ins and outs of the daily trading in the markets in Europe, because you have a keen kind of awareness of it. So what do you feel like? What's going on in a daily trading perspective, from a technical perspective, from the asset managers in Europe?
To be perfectly frank with you, I think that it's most probably one of the most technical markets that I have seen for quite some time. We have seen such a significant decoupling between fundamentals and technicals. That it is staggering, actually. I want to go back to a point that Ben was making. Again, because of the technical aspect of this market, you are seeing people forced to actually liquidate, again, holdings which are, again, in companies, real estate, things that are actually solid. They're good. It's just the only thing they got to sell, the only thing they can sell without taking a 40-point markdown. So that's what creates opportunities, and I think ultimately that is what a lot of people on the asset management side, a lot of people, again, in terms of funds, are ultimately looking to capitalize on. But then you got the other side of things, and you have, again, the real money community, etc. And the reason I'm saying the market is so incredibly technical is because what we're seeing right now, this market trades entirely to the tune of one thing: inflows, outflows. I got inflows, prices are up. I got outflows, prices are down a lot. So quite frankly, when is Europe going to reprice? When we actually start seeing US allocators take money away from the real money community, and then things are going to drop, and they're going to drop hard because they're entirely too high. Listen, I think that the price action is more pronounced in terms of equities. I just think European equities are in a special place, which I cannot explain. I think that European credit is being, it's a tale of two cities, i.e. like it's between rates and equities, and rates are at least, holding it accountable to a certain extent. So it's not completely over its skis. But still, I think that there is quite a bit of room for correction. So as long as we continue seeing inflows, and by the way, the rally over the past 48 hours in Europe, I think is very much a function of the fact that all primary has been pulled. So you got inflows, you got no primary, therefore secondary prices up. That's how technical it is. People don't pay attention to the fact that, again, like some of these issuers are going to be bankrupt over the next couple of years. That's why it's so scary, quite frankly. When you decouple from fundamentals at this point in the cycle, again, I just have had several moments over the past 48 hours where I'm in the, what is the name of that story? The Emperor Has No Clothes. Definitely, having a little bit of that.
Speaking of emperors with no clothes, Terry, what's your take on the regulatory framework around U.S. banks going forward? Do you think we're going to see significant changes in the way banks are treated, whether it's deposit insurance or tighter, capital restrictions on certain banks? Like, what do you hear anything about changes coming down?
Yeah, there's a tremendous amount of chatter around this. The politicians in D.C. are all up in arms. None of them understand what happened. But they're all mad. The regulators are in a tough spot. A bank CEO told me a long time ago that the politicians and the regulators watch a disaster unfold, do nothing to stop it, and then when it's over, they rush in and shoot all the survivors. We're going to see some of that here, I think. They don't understand what happened, and therefore yes, there's a lot of hoopla in DC. I do think there will be some incremental regulation. I think it will probably be around deposit concentrations and how bond portfolios are managed. And I hate to sound like a broken record, even though that's not what made Silly Valley or Signature fail. It was a run caused by a stupid decision to announce an offering before they had it done. So yes, I do expect there'll be some changes around this.
Terry, actually, I have a question in the chat box about the advice that Silly got, and particularly, what was the rationale behind doing the capital raise that way? It's not my question. It's in the chat. So.
You would have to ask their advisors, which were Goldman Sachs, and an investment bank called Leerink. Leerink is a healthcare-focused investment bank that doesn't do anything in the banking sector. They were in the deal because Silly Valley owns them. So I think they got really bad advice from Goldman on this. We can speculate. One of the speculations is they thought the stock would actually go up on the announcement of these changes, which we had heard was discussed. Whether that's true or not, I don't know. The other possibility is they were looking for price discovery. I don't think they imagined that the price they were going to discover was zero. But that's the other thing. So it was an unbelievably foolish mistake. I didn't say this earlier, but when my analyst who covers this for us said to me on Wednesday afternoon, they're going to price it Thursday night, within a second of him saying that, I responded with, "That's going to be a disaster." Now, I didn't think it was going to be a disaster that took the stock to zero and caused the regulators to seize it. But the moment we heard, we knew it was a disaster. It was a really bad decision.
We actually don't have any more questions in the chat. So does anyone have any other comments they'd like to leave the group with before we sign off? Well, cool. I want to thank everybody for participating, to Terry, Eva, and Ben, and to everybody who tuned in to watch. Thank you so much, everyone, and enjoy the rest of the week.
Thank you.
Thank you.
Bye. Thank you.
Thank you.